This is my ideal setup. This is what I would want if the market could listen to me. This is what I would ask for. Each and every trader is different, but at the end of the day, we just trade the same thing. Some people deem this as a valid break of structure. Personally, the way I trade, I just deem this as a premature liquidity sweep. It's okay as a trader to say, I'm not sure what I'm seeing. If this range doesn't have an imbalance, like this range from bottom to top, if it does not have an imbalance, I won't entertain the setup. What lot size I use. I feel like that's the most irrelevant or useless question you could ever ask. What lot size do you use? There was not, like I said, there was not a single time where I've used the same lot size.
Yo, what's up guys? It's here from Top Trader, and I'm bringing you guys another episode of Chart Masters, which is proudly sponsored by Exness. If you guys are looking to explore the Exness terminal, please make sure you go to the description below and use the link down there. But as for today, we have a returning guest on the channel. You guys love him. We all love him, guys, period. We've got Ballo with us, Ballo Trades, also known as Mohau, but obviously the industry knows you as Ballo. Yeah, how are you?
Feeling amazing. It's good to be back.
No, thank you for coming back, bro. I'm really excited for what we're going to get into. You guys know I have views on SMC, guys. I've said some stuff over time, but I think from my side, it's all about, I'm always willing to learn and whatnot, because obviously SMC, guys, it's feel like they found the holy grail. But I know it's not all about that, you know, and I think that's what I'm here to do, is learn today and see, and obviously with the guys watching at home. But before that, how are you doing?
I'm feeling good. How about you?
Nah, I'm all right. Excited to get into it. How have the past few years? It's been a year since we shot, almost a year.
Nope. It's been more. I think I came here start of the year, March.
This year?
Yeah.
This year?
March,
Yo, time does not... Okay, I don't know how time is moving, but it feels like it's been a year or whatnot. But how have things been so far?
It's been going absolutely amazing.
Yeah.
Obviously, there's disadvantages here and there, but then overall, we're just going up. Yeah.
Okay. How have you been dealing with, have you been, since we shot, obviously, the interview blew up, and then obviously you had an influx of people coming in and hitting you up, but also, like, how has the journey of trading been since we last sat down and spoke?
It's been quite the same. Obviously now my channel, my personal brand has grown even bigger. But in overall, it's just been a steady, gradual growth. Yeah. But I appreciate each and every thing that's happening. But then it's just been growing from there.
Okay. No, perfect. Okay, so today we had to talk SMC. You said SMC, ICT. What's the difference? Do you know what the difference is?
I don't know. I think it's the terminology. Because at the end of the day, we just basically trade the same thing. We just call it different names. Yeah. Some people call it change of character. Some people call it whatever they want to call it. So just think the difference is the terminology that's used. Yeah. Yeah, but then I don't even call it SMC, ICT. I'm just trading whatever, whoever wants to call it whatever. It's up to them. I just trade what works.
Okay, no, that's fair. So we can get into what works for you. So you can start us off. You can kick us off with where you usually start before we get into the strategy and psychology conversation. Let's quickly look at something that many traders tend to overlook. Psychology does not only matter after you've entered the trade, it starts before the entry. Inside the Exness terminal, before making any decision, a trader can first mark the area they are watching and define the idea clearly. This helps separate analysis from emotion, because the trader is not just reacting to price movement in the moment. On the right-hand side, the risk calculator form helps traders think through the setup before entry. Instead of rushing into the market, you can review details like risk, stop loss, take profit, and position setup first. A trade may look clean on the chart, but if risk does not fit your plan, discipline means being able to wait or walk away. And if price is not yet where you want it to be, you can wait instead of forcing an entry. And that is where strategy and psychology meet. Preparation before action. The Excel tools shown are provided for informational purposes only and do not constitute as investment advice or recommendation to trade. Past market movements do not guarantee future results. Always conduct your own independent analysis and make sure that you understand the risks involved. Now, let's get back into the conversation around strategy, psychology, and disciplined trading decisions. Yeah.
So I use one time frame. As you guys know, I'm dominantly a swing trader.
Yeah.
So I only focus on the 4-hour time frame, right? This is the only time frame that I use, right? This is the only time frame that I use. I don't use any other time frame except for the 4-hour. Sometimes I would maybe say the daily. But
you go up.
Yeah.
Gee.
Yeah, I don't go down. Sometimes the daily. But the daily, I use it like 5% of the time just to check the overall direction and stuff. But then I get into that on how I use it daily. So my strategy is simple, right? From the surface level, it's simple, but then obviously it goes deep. So I look for, I'm going to now share the confluences that I look for, right? The first one, the most important one, is the break of structure. If I don't see a break of structure, then I'm not going to look at the charts at all, right? Okay, let me just say, because this is going to make sense in a bit of time, let me just say a clear break of structure, because break of structures are different, all right? The second one is when the break of structure happens, I look for an imbalance, right? An imbalance, for those who don't understand, an imbalance is just, I just use the imbalance as it serves as a magnet to pull price back towards it and fill it, then it goes wherever it was going. So I just use it as a confluence, but it will make sense, right? The third one is, the third one is more of a tool that I use, which is the Fibonacci, right? Fibonacci, right? Which is the Fibonacci. And in the Fibonacci, there's multiple levels to use. I personally use the 0.71, which could be the 71%, right?
Interesting. Okay, I will ask questions for that, yeah.
Okay, so another one, confluence that I usually look for, what do I look for again? Sometimes I would say the trend, though if I don't have the trend in my favor, it's not really a trend smash, right? But so I like to follow the trend in most cases. Then another one is liquidity sweep, right? Also this one plays a part, but it's not really that significant, right? So, okay, so I'm just gonna show you how I use this, right? Say we have a trending market, as you can see, right? Obviously the trend here is bullish. Now we have obviously our bricks of structures over here, bricks of structures.
Why are we calling it? So sorry, I'm not a person who's keyed up with the terminology, so I need to ask why. Because usually when you put something like this, I'm seeing like what is this higher? Yeah, you understand.
Yeah.
So why are you calling it break? Why is it defined as a break of structure?
Okay, so we have this, right? We have a push and a pullback.
Okay.
So this is structure. Okay. So when it comes beyond that structure, it's a break of structure.
Oh, so it's the whole thing
basically,
here.
yeah. Okay. So basically, the high has been broken.
Yeah.
High is the structure. Oh. So it has been broken. So that's why we call it break of structure. Someone might call it something different. Like I said, it's just the only difference that the terminology with each and every trader is different. But then at the end of the day, we just trade the same thing, right? So yeah, it's the break of structure, right? That is the first confluence that I look for. Now, putting more emphasis on this, right? The reason why I say clear break of structure instead of a break of structure, right? We might have a higher high right here, right? The higher high. Price breaks structures differently, right? Sometimes it breaks like this very correctively. For me, this is not clear.
Okay.
It is a break of structure, but it's not clear. As you can see, there's a difference between this and what we have over here, right? I look for something more intentional, right? Something that you don't have to think twice. It broke structure. It's very clear and simple, right? And another break of structure that I personally don't deem valid to be a valid break of structure is when maybe we break with a wick, right? Maybe, okay, let me just say this because I can't draw. Let me just say, I'm just going to draw a candle let's just say we broke in this manner, right? This is a break of structure.
Okay.
Right? Some people deem this as a valid break of structure. Personally, the way I trade, I just deem this as a premature liquidity sweep. It just hasn't been confirmed yet. So I'd like to look for a full candle break.
That breaks above
and
doesn't close below.
It doesn't close below.
So this would have been closed below it.
Yeah, so
regardless
it's like,
of the okay.
Yeah, so it's like a bit shaky. You know, it's like I'm not really sure. Right? And sometimes it's okay as a trader to say I'm not sure what I'm seeing. That's when it's important to sit on your hands and just wait for price to develop. Sometimes price just needs to develop, right? So we have this. This for me is not a valid break of structure. I like to look for a candle break, and not just a candle break, but multiple candles that breaks above. Maybe we say have that candle, right? We have maybe multiple candles instead of just one,
okay.
Right? I like to have multiple. I don't have a rule of thumb, maybe how many, but I'll see it once I see it. I don't know if I'm making sense.
Okay.
Basically, emphasizing on the clear break of structure, I look for multiple breaks of structures above our break of structure.
So you just need it to be proper confirmed.
Yeah.
Okay, so but in this case, since we're going up, we're looking at like going up, wouldn't one want to argue that you're kind of missing out on the move, or are we planning to go down, or are we still planning to, but when this happens, are you looking at a buy?
Now, when this happens, this is the first step.
Okay.
Like right now, we're in step 1.
Okay.
Right? We're going to go into step 2.
Okay.
Right? Now, we had let's say we had the clear break of structure. Right? It's clear. You don't even need to think twice about it. It's very clear. Right? This is the first step. Clear break of structure. Now, you're going to wait for price to have a solidified low, a solidified high in this case. Right? So how do you see that when price starts to retrace with multiple candles, right? Obviously, when it's here, when it's still above there, it's not yet solidified. So anything can happen. Price could just continue going to the upside, right? You're going to wait for a solidified high, all right? And how do you see that? You're going to see price retracing a bit. Then from there, we could say that we have a solidified high. Now, in my trading view, I have a specialized indicator that has been quoted by a friend of mine. Some people say I stole it somewhere, but it's been quoted by a friend of mine, right? It has an indicator which shows you there's an arrow that comes up. I don't know if you've seen my charts before. There's an arrow that comes up at the high.
Okay.
So when that arrow pops up over there, it means the high has now been solidified. So now price is retracing, right? That's the second step. No, that's after the break of structure, that is what we look for, a retracement, right? Okay, price is now retracing. Right?
So sorry, with the high, but also a person can also identify the high manually, so correct?
Yeah.
Okay.
Yeah, it's just, I just use the arrow just to have less chart work. Okay. Basically, I just see the arrow, then I'll be like, okay, this is now solidified. Now we have a retracement. We're gonna look for an imbalance. An imbalance, basically, for those of you guys who aren't really sure, I'm drawing candles right now, right? An imbalance consists of 3 consecutive candles, right? We have the wick. Okay. So now, an imbalance, how to spot an imbalance is basically the first candle and the last candle of 3 candles. So like I said, it consists of 3 candles, right? So if you see the bottom wick not making contact with the top wick of the third candle, as you can see, this is the first candle, the second candle, and the third candle, right? If this wick of the first candle doesn't make contact with the third wick, it leaves a gap. As you can see, there's a gap over here. Usually what price would do, would have something like this. Now, what I'm about to draw is price without the imbalance, right? Maybe let's say we have that, right? Then we have, obviously that's possible, right?
Yeah.
Now if you look at it, okay, let me just, okay, as you can see, between this first, the second candle, and the third candle, right? The wick, the bottom wick of the first candle makes contact with the wick of the third candle. There's no gap over here, right? It's 3 candles. But in this case, there is a gap, as you can see. Now, this is called the imbalance.
Yeah.
just basically a place of insignificance. Price usually draws back to fill in this imbalance and goes back to wherever it was going, right? So this is a basic visual representation of how an imbalance looks like. It consists of 3 candles, right? I'm just going to wipe this to get back to what I was saying.
Okay.
Right? You're going to look for an imbalance. It's very clear after you have seen it a couple of times. It's very clear, right? You're going to look for an imbalance. Now with imbalances, right? Obviously the imbalance could be, this is a range by the way, right? From this low to that high.
Okay.
This is a range. This is what we call a range or a leg for, different terminology. An imbalance could be somewhere here or just anywhere on the charts.
While going up.
Yeah.
Okay.
So ideally, I would like to have the imbalance seated on my 0.71 retracement. So now, when price starts to retrace, this is when we draw our Fibonacci from the low to the high, right? So I've eliminated every other level on the Fibonacci and just left out the 0.71.
Why 71? Because I know a lot of people usually look at the other significant levels.
The golden zones.
Yeah.
So with my backtesting, I've seen that the 0.71, it usually comes back to the 0.71. It's just basically, I'm just using the Fibonacci to structure my trades. So if I use the 0.71, I constantly, so let's say this is a 0.71 seated here, right? Just say this is a 0.71. Obviously this is a 0, then the 100. No, this is the 0. And this is the 100, right? This is our 0.71, right? This is the way I frame my trades. So with this being like this, my RR, when I put on my position tool, my risk to reward ratio, it's always the same, right? Just that right now I don't have the charts to show you. It's always the same. No matter how big the range is, no matter how small the range is, as long as I draw my Fibonacci from the low to the high of the range, and I use the 0.71, right now I'm looking for a buy. Basically in this setup, I'm looking for a buy, right?
Okay.
I'm looking for a buy. This is where I put my entry, my stop loss. Stop loss is here. Okay, let me just use a different color. This is where I put my entry, my stop loss, and my take profit. Does make sense? Back at the high.
Okay.
Right. So it's basically a way to structure my setups, my entries. Right. I enter here, put my stop loss over here, and I put my TP over here. Now, why do I put my TP at the low? Basically, when price reaches this point and breaks it, the trade setup is now invalidated, right? And the reason why I target this high is because it's the place of least resistance. Price could you see price could go like that, right? In most cases, this is an area of least resistance after price is done pulling back. We have the push, we have the pullback, and we have the push. Now, in an uptrend, it's easy for price to break the next higher high.
Okay.
Right, this is the higher high, then the higher low.
Yeah.
Right. The higher high is the place of least resistance. Basically, it's just easy for price to just break that point.
Because we have a trend.
A trend, yeah.
So going.
Exactly.
Okay. So even with a downtrend,
the lower low is a place of least resistance.
Okay.
Right. And obviously, you don't know how long price is going to go for. So it's just easy to target the next higher high.
Yeah.
You get what I'm saying? It's the path of least resistance, right? Fine, I have to put my entry over here, stop loss over here, my TP over there. Now, using the 0.71, I always have a constant risk to reward ratio, which is a 1:2.45.
Okay.
It's always like this.
Always.
So if you see my charts and you see that I hit TP, just know I've made this amount times my risk, right? For now, let's just say I use a 1% risk. It's 1 times this.
Yeah.
So I'm about to get 2.45% profit.
Yeah.
It's always like that.
Always.
My RR does not change no matter the setup.
How did you get to that particular figure?
0.2.
Yeah, no, the 2.45. How did you get to figuring out that this is your sweet spot? Because why I'm asking you, how did you get to figuring out your risk reward ratio?
Yeah.
is because there's someone at home, they're going to look at yours and be like, oh, Ballo's risk reward ratio is 2.45. Let me also make mine 2.45, but unaware that the way they trade and the way you trade is very different. So how did you get to deciding that 2.45 is your sweet spot?
Okay, so what identifies my risk reward ratio is basically the Fibonacci tool.
Okay.
If I use a lower Fibonacci tool, remember that I frame my trades on the Fibonacci tool.
Okay.
All right. I put my entry at 0.71. Now, if I use a lower level, such as maybe let's say I use another level, maybe this one is 0.80. Now my risk reward changes, it increases.
Okay.
Which now becomes 1:2, maybe 3. Okay. Because now it's lower, my entry is now here instead of here. So obviously this gap increases, which increases my RR.
Yeah.
Right. So like I said, back testing, I found out that 0.71 is where price usually most often retraces, not always obviously, just usually retraces from. Right. So using a different Fibonacci level, the lower one below the 0.71 increases my RR. Just that I know some people at home might be watching the 1 point RR and be like, okay, but that one is more significant than the 2.45 RR. That's okay, but then you have to understand that when price retraces, it doesn't really retrace that deep enough to tap you in on the 0.80, basically the 80%, right? It usually plays around the 0.71. So that is how I find my sweet spot, by backtesting and found that, okay, this usually retraces all the way to the 0.71. Some members in my group use the 0.75, which also increases their RR, but then they usually miss out on good trades, because you might find out that price is dropping, right? Then it doesn't retrace deep enough to tap whoever chose the lower, for example, the 0.80, then price leaves you behind and goes to hit your intended TP, right? It left you behind, it didn't tap you in. You get what I'm saying? So yeah, that's, to answer your question, that's how I found my RR, which is 2.45.
Okay.
All right. So okay, now let me just go back to. Okay, so we have already established that, okay, I'm looking for a buy, right? We're still on the imbalance, right? Okay, so I'd like to switch these two around, right? I'd like to make this 2 and this one 3, basically. Fine, I draw my Fibonacci tool, right? If this range doesn't have an imbalance, like this range from bottom to top, if it does not have an imbalance, I won't entertain the setup. So the range that I'm looking at has to contain the imbalance. It's important. If I don't have it, I don't even look at that direction. I don't even look to trade that particular asset, right? Now that's the third one. Okay, let's say for example sakes, we do have an imbalance. Now, okay, we have marked the first one, we do have it, the first one, we do have an imbalance, we have drawn our Fibonacci tool, right? Now I look at, are we following the trend, right? If the answer is yes, then that increases the probability of the setup. If we're going against a trend, that's not a trend smash. It just means that the trade probability has been reduced if I'm going against the trend.
Okay.
Right? So in this case,
if you're going against the trend, that means the
probability of the trade playing out
has reduced. I'm going to need to see that.
Okay. Yeah. So let's say we're in an uptrend right now.
Okay.
So we're looking for buy. Obviously, we're following the trend.
Okay.
Right? Fine. The trend is in our favor. So now I could be more confident. Okay, now we're following the trend. The chances of me losing are low. Though they still are, they're just low. All right? Now, another one is the liquidity sweep. So I'm going to put a star on this one because this one, it's kind of 50-50, right? So as you can see right here, I've put a star on the liquidity sweep. The reason being is because if I'm following the trend, like this trade that you see, if I'm following the trend, then a liquidity sweep is not necessary. The liquidity sweep is only necessary when we have a trend change. For example, right, price could just continue going, right? Now over here, something like this, okay. So now this is a liquidity a liquidity sweep, right? Because now we've broken structure to the opposite side. BOS to the opposite side, right? Now I'm looking for what? I'm looking for a sell, right? This is when the trade setup is going against the overall trend. I need to have a liquidity sweep just to give me confidence that, okay, price has swept liquidity. Now we could be looking to take trades in the opposite direction. But in this case, since we are in an uptrend, there's no need for me to have a liquidity sweep.
What is a liquidity sweep?
Okay, so liquidity sweep is just basically, let me show you. Okay, so over here, you've seen trend line traders before, or double top traders, or whatever they classify themselves. It's like there's seated money. There's money seated at each and every high.
Okay.
Right? Most traders are looking to target those highs. For example, right now we have a higher high. Right? Now, when the price breaks the higher high, most traders are looking to what? To buy. Because now it's just a trend continuation. Most traders are looking to buy. Now, price might fake out to pretend to make as if it's going high, only to fake out, to come back and hit your stop losses, which might be placed just under the high. So liquidity it's another name for money, right? So yeah, that's just basically the way I view liquidity sweep. Someone out there might view differently, which is okay, just that we train the same thing, right?
I see.
So we have a liquidity sweep right there, right? This is the only time liquidity sweep is mandatory because we're going against the overall trend.
Okay.
Fine. But in a setup like this, where we're going with the trend, there's no need for me to have a liquidity sweep, right? If we do have one, then that's a plus bonus. It's a bonus. But if we don't, then it's completely okay. For example, I know you might be confused. Let's say we have something like this.
I know you might be confused.
Yeah.
Hey, I'm trying to follow here.
Yeah.
Don't
Let's say we
worry.
have something like this.
Okay.
Right? Something like that. This is bullish. Can you agree?
Yes.
This is bullish. It's been breaking structure to the upside. Right? Now, price had a moment where we had this.
Okay.
This is a liquidity sweep. Right? Because this was a low.
Oh, okay.
Right? So we have a liquidity sweep in an uptrend. Right? So now having this as a confluence adds to the probability of the setup playing out. Right? We might have, if you have this, then it's a bonus. If you don't have it, like here, as you can see, we didn't have a liquidity sweep, we never had a liquidity sweep. If we didn't have it, it's okay because we're just following the trend.
Okay.
It's only here where we look for a liquidity sweep, where liquidity sweep is very important. If we don't have a liquidity sweep, then we're not going to enter the setup. Just basically
the setup of, so is the setup going into here? No, we're still here. The setup is still going
so
here.
let me make an example, right? Let me just make an example. Let's say we're going against the trend, but we don't have the liquidity sweep, right? We do have a break of structure right here. But where is the liquidity sweep? There's no liquidity sweep over here.
I see.
You see what I'm saying?
Okay.
Right. Maybe you're looking for a buy. Now this just makes you're looking for a sell. Now this sell just makes, it's just invalid because we don't have a liquidity sweep.
Okay.
Does it make sense?
So in other words, I'm trying to follow. Yeah. Liquidity sweep would be over here. If I'm understanding correctly, or am I not understanding correctly?
You're not understanding correctly.
Yeah.
But yeah.
Wait. Thing is, you keep saying sell. This is like this would be something you're selling into, right? Like something. This is where we are selling, correct?
Yeah.
Are we agreeing that this is
it broke structure to the downside?
To the downside. So we're looking for a sell position.
Yeah.
So in other words, where's the liquidity sweep here?
There's no liquidity.
There's no liquidity sweep.
Yeah.
But if there were to be, where would it be?
It would have been something like this. Let me just remove this. Would have been something like that, where it broke that high.
Oh.
You get what I'm saying?
No,
where
I'm with you.
That high.
No, I am with you now. Okay,
yeah.
I get it.
So now, in this case, we didn't have it. We didn't have the liquidity sweep.
Okay.
Where is it? There's no liquidity sweep.
Oh, okay.
So taking the sell over here would be Quite not normal.
Risky.
Yeah, risky.
Would be
Extremely risky.
Okay.
You get what I'm saying?
See
But
now.
if we have a liquidity sweep, remember that this trade is going against the overall trend.
Okay.
Right? Now, for us to have an increased probability, price needs to break liquidity, needs to take liquidity.
So obviously, when the liquidity, if there's a liquidity sweep over there, it means that some money was
taken.
Lots.
People were buying and just the market just...
And not just a little, a lot.
Yeah.
So which would kind of justify going against the trend. Okay,
exactly.
no, I do see. Okay, I get it.
You know what I'm saying? Now price has momentum to go to the opposite side.
Okay.
Right? It has the means to do so. Right? So this is the only time when price takes liquidity. When I'm using like liquidity like as a mandatory factor. This is the only exception I have. But in terms of this, following the trend, a liquidity sweep is not necessary. If I do have it, then that's a added bonus. But if I don't, then it's not a trend smash. I might still take the setup.
Okay.
You get what I'm saying?
So with here, where would the liquidity sweep be? Would it be to the downside, of course?
Here we're looking for a buy.
For a buy. But if there was to be, because you said it's a 50-50 thing.
Yeah.
So without it, it's fine.
Yeah.
But what if it's there?
The liquidity is there.
Yeah, well, the liquidity sweep. What if there's a liquidity sweep? Would that make the trade invalid, or would that make your...
It would be an added bonus.
Okay.
Added bonus.
Okay.
If we have a liquidity sweep, maybe let's say we're following the trend, then we have a liquidity sweep.
Okay.
Even though we're looking for a buy in an uptrend, if we have a liquidity sweep, it still be an added bonus.
Okay.
Like I like the one I showed you here, right?
Yes.
We're still going up. Like holistically, we're still going up. But here we have a liquidity sweep, right? Because it broke structure to the downside, but then the overall is... Well, this was a fake move. Basically, this was a fake move.
Yeah.
Right? You might see this as a big structure to the downside, but price ended up breaking against structure to like wherever it was going. So if you have this, now we have something that looks like this, right? Fibonacci from the low to the high, target at 0.71, right? We have the liquidity, we have the break of structure, we have the imbalance, we have the Fibonacci, and the trend is in our favor, and we took liquidity. Now this is my ideal setup. This is what I would want if the market could listen to me. This is what I would ask for, right?
Yeah.
But then obviously that's not the case, so we just have to deal with what we have, right? Now I think we covered everything over here. Okay. Now obviously, now we have a clear imbalance, a clear break of structure to the upside. We have an imbalance which is seated right here. We've drawn our Fibonacci tool. We are following the trend. A liquidity sweep, we don't have it, but then it's an uptrend, so I don't really need to have it, right? From here, if the chart is looking like this, I set my buy limit orders over here. Set my buy limit orders, and just let price be. I'll have to wait for price to come all the way. Remember that my entry is here. I've set my buy limit. So buy limits are basically where you set your positions. That when price comes to that level, it just taps you in automatically. You don't have to do it manually. Yeah. Right? It just basically, you just have to do it like you set it. Then
there's your buy stop, sell limit, buy limit.
Okay, so you want me to explain
Yes.
Okay, so we have the buy limit, right? The buy limit basically means you just want to continue the trend. For example, right, in an uptrend. You're assuming that, okay, once price gets here, you're going to want to buy here, right? This is where you set your buy limit orders on method 3 or 5, right? You're assuming price will do that, right? Now, with a buy stop, you're assuming you set a buy stop just, for example, in a downtrend, you set the buy stop under price.
Okay.
No, the sell stop. This is a sell stop. Yeah, sorry, excuse me. This is a sell stop, right? In a selling scenario, you're assuming price will just continue to the downside. So once price gets here, it will just continue.
Okay.
But if you're looking for like something like this, a buy stop is the entry.
So in other words, buy stop would come from underneath.
Buy stop would come from, no. Are you talking about buy stop or buy limit?
I get how you said buy limit. Buy limit is here. So buy limit comes from, gets triggered like that.
Yes.
A buy stop
Just goes.
would be like that.
Yes.
And then a sell stop, obviously,
Like that.
And then a sell limit.
Yeah,
like
exactly.
that. Okay,
exactly.
I
That's
see.
the basic definition of it.
Okay.
Without complicating anything.
Yeah.
Right? So here I set my buy limit.
Yes.
Makes sense?
Yeah,
Set my buy limit, set my tip over there, stop loss over there. Then I just wait.
Okay.
Sometimes you might find that you might find out that price doesn't retrace deep enough to type you in. Then it just leaves without you. It's completely okay. It's normal. You find another trade around the corner, right?
You around the corner is days, most.
Exactly, yeah.
Because you're looking
It's
at a 4-hour time frame.
But you have to remember that I'm looking at multiple assets at the same time.
Yeah.
Well, not at the same time, but I look at each and every morning. I wake up to analyze 23 assets. Currency pairs, gold, as well as NASDAQ. Within those 23 pairs, I analyze them. I'll analyze them like at the same time. Then maybe I might come out with maybe 3 pairs that are looking good for that day. Then instead of focusing on these the whole time, I just focus on the ones that are looking good. Because not every asset will look good.
Yeah.
You get what I'm saying? So people confuse me of saying that I look at 23 pairs as like, isn't like I'm looking to trade 23 pairs at the same time.
Yeah.
No, I just analyze 23 pairs each morning, pick ones that are looking good for that day, could be 3, then I just focus on those 3 instead of these 23.
Okay.
You get what I'm saying? Sometimes you can get that out of the 23 pairs assets, there's absolutely nothing that's shipping up. Then now you wait for the next day. It's possible. Remember, I'm looking at the 4 hours. It's possible. So remember, I'm looking at 23 assets, right? I pick ones that are looking good for that day, right? And then I just focus on those. So
is this like an everyday thing? Everyday thing. So in other words, Monday, wake up, you look at 23.
Tuesday,
choose your whatever's looking good.
Exactly.
So even if it's not necessarily 3, it's like whatever's looking good.
Whatever's looking good. Sometimes might be 1, sometimes might be 5. Sometimes I might not find anything.
Okay, and then Tuesday we come in again. So what if on the previous day you already opened a trade? Do you come in on Tuesday? So on Monday, you let's say for the purpose of this, you open 3 trades on Monday.
Yeah. Okay.
Then on Tuesday, not 3 trades, but you found 3
assets that are looking good.
They're looking good. Then you execute on one of those pages that looks the best. Obviously, that kind of has all your confluences.
Yeah.
And then on Tuesday, you come to the charts. Do you open all 23 again, and you look at that? Because now you have 1 trade running so far.
Okay. So within my trading rules, I have a rule that I'm not allowed to open more than 3 trades at the time.
Okay.
So I take 3 trades max. I don't want to see anything more than 3 trades running at the same time. I'm not that type of trader that just sells like this. I want to see no more than 3 pairs running at the same time because I'm risking 1% per setup, right? So it's like if I have 3 positions running at the same time, that means I have 3% worth of open risk, right? Now, at the back of my mind, I know that, okay, these 3 positions could hit stop loss. So it's like I'm not willing to lose more than 3% at the same time. So that's why I limit myself to 3 positions, right? Now, let's say Monday I took a setup. Okay, let me just say we analyzed 23 assets, right? Then I come out with 3 that are looking good on Monday, right? Now we go to Tuesday. Right? Now, in most cases, you'd find that within those three assets, they're still looking good, right? Then same thing, I go through the 23 pairs. Then if necessary, maybe 1 is shaping up again. Then I add on top of this. So now it makes it 4 positions that I'm looking at, not trading, that I'm looking at. You get what I'm saying? That I'm looking at might be 4. For example, okay, fine, they're still moving. Remember that I'm looking at the 4 hour. So price really moves slow in the 4 hour. To put this into perspective, we have 6 candles a day on the 4 hour. It's only 6. Because if you do the math, it's only 6 candles.
And imagine you're looking for an imbalance on 6 candlesticks.
Exactly.
You
get what I'm saying?
You need at least 3 candlesticks to give you something solid.
That's half a day. 4, 8, 12, that's half a day.
Yeah.
All right? Then I add, now we're looking at 4 pairs. Now we go to Wednesday, right? Wednesday, maybe 2 might be invalidated. Now we're looking at 2. Then I analyze through those 23 pairs again. Nothing shaping up, anything new. Fine, now we go back to 2. So it's just basically that. I just analyze 23 pairs each and every day to see what's looking good for that day. I might cancel ones that are no longer looking good, or maybe I find another one that's looking better than what I saw yesterday. Then I just remove that one from my close watch, right? Okay, so yeah, that basically summarizes me trading those 23 pairs, right? Obviously, I have my majors, which is the Euro USD, the USD JPY, and I also use the DXY as a confluence. I don't trade the DXY, like I wouldn't execute on DXY. I just use it on I just use it as a confluence when trading USD pairs. So for those who don't know what the DXY is, the DXY just represents the
dollar index.
The dollar index.
Yeah.
So when the dollar gets stronger, the DX rises. You get what I'm saying? So I use this as a confluence to trade most often Euro, USD, as well as GBP USD, right? The DXY is rising, which means the dollar is getting stronger, right? So we have a bullish market on the DXY. So on Euro USD, what could we expect to happen, right? Could expect the market to go to the downside because the dollar is getting stronger. You get what I'm saying? So I use it as a confluence that, okay, I start on the DXY each and every day. I start with the DXY. Okay, DXY is shaping up like this. I'm looking, the DXY is looking for a buy. I'm not going to enter on it. I'm just using it as a confluence. The DXY is about to buy. Before I go to Euro USD, I should expect for Euro USD to sell because DXY is buying. Now, DXY and Euro USD are negatively correlated. What that basically means is that when the DXY is buying, the Euro USD asset must sell.
Yeah.
So they go opposite directions. When the DXY is selling, Euro USD is buying. Right? These two pairs may basically move same to each other. Like it's basically the same thing.
So whenever USD on the, so for instance, you get USD, JPY, and then you get Euro. See, so whenever it's on this side, basically, and then whenever it's on this side, it's going.
Yeah, if the DXY is going to buy, since the USD is the base currency, it's also going to buy.
Okay.
Because it's getting stronger against the JPY.
Okay.
So that's the basic logic of it.
Do you look at other, do we have, sorry to forgive, I don't know if it's ignorance or what, but it's curiosity. Do we have indexes for other currency pairs?
The only one I know is for JPY.
Okay.
Which is the JP225.
Oh,
it looks like this, JP225.
Okay.
It's also a confluence you could use for JPY. Right? So when this just basically represents the Japanese yen index, same as the DXY to the US dollar.
I see.
So for USD JPY, I mean for JPY, it's JP225. You can look it up on your trading view. It's there.
Yeah.
Right? So
you can move this as well.
So yeah, that's the basic summary of basically my strategy and what I do each and every single day.
Sure.
Right.
Yeah,
obviously, it's an abundance of information, but then it's really simple if you start to, train your eye to see it.
It's simple for you now.
Yeah, but we've been doing it for multiple months.
So you said with the daily, you only go, this is for this, or it's like every day. So, it's a sometimes. I want to understand the sometimes part.
So with the daily, we're going to get a bit more technical, right?
Okay.
I'm on the 4 hour right now, the 4 hour time frame, right? 4 hour time frame maybe looks like this. It's moving quite normal, right? The 4 hours moving normal. Then you get another chart that might look like this, right? So as you can see, on the 4 hour, when I'm focusing on this break of structure, we're looking for retracement. You could see that, okay, there's price action to the left side of the what you're looking at. You know, it's like you could see price action without having to zoom out. Basically, when you open your trading view, it puts you at default mode where like you could see everything that's going on, right? Then you have price action basically to the left side of it. Then you get another time where the 4 hour is just overly extended to a point where you see nothing to the left of it. I call it like when price arrives there, I call it the 4 hours just basically in the middle of nowhere. That's how I put it. It's just basically in the middle of nowhere because you can't see anything to the left side of it.
And even if you were to scroll back and find something there, it's far, but it's what you see in the moment.
At the moment, there's nothing to the left side of it.
Okay.
So in this case, when price is this bullish, it's when I say the 4 hour is in the middle of nowhere. You see here, okay, you can see that, okay, we've been trending over here, we had that. But here, there's nothing to the left side of it. The 4 hour is in the middle of nowhere. This is when I hop on the daily because it kind of zooms out the daily without me having to zoom out manually. When I hop on the daily, it just basically zooms out.
So you wouldn't zoom out on a 4 hour? No, you don't zoom out on a 4 hour?
I like to focus on the recent.
On recent, then that's why you go to the daily. Okay.
The daily. Also on the daily, I look at the recent, but obviously the 4 hour is baked in the daily.
Yeah.
Right? So, yeah. At this point, the 4 hour is in the middle of nowhere. I wouldn't want to buy here.
Yeah.
Because price is just overextended to the upside. I wouldn't want to buy when price is just up there. Because it's going to come a point where now it just retraces like very, or pull back very aggressively. I don't want to buy here. Right? Here, I could buy because now, okay, price action, I've been seeing it to the left side of it. I've been seeing how it's been moving. But here, the 4 hour is overextended. It's to the upside to a point where I can't see anything to the left side of it, right? So this is where I incorporate the daily when the 4 hour is in the middle of nowhere.
I
so
see.
That's how I use the daily. Though obviously that's sometimes. The 4 hour won't be overextended for the whole time.
Yeah.
Just those few times. So that's when I include the daily. But in terms of my day-to-day market analysis, I don't look at the daily at all. Okay. I only focus on one time frame. I know my people have their own opinions about, you need to have multiple time frames to back your what. I just focus on the 4 hour time frame. It's just working for me. You get what I'm saying?
What kind of psychology needs to be backed up to trade like this? Because 4 hour time frame, I think it really requires you to be mentally strong. So First and foremost, obviously, you need to have extreme patience. Extreme patience. Because I remember when I was transitioning from day trading to swing trading, it was the most horrible time in my trading journey. Having to move from looking at the 15-minute to only looking at the 4 hour. You could tell how that would psychologically impact you. You get what I'm saying? You go 3 days without taking this setup, probably a week. You get what I'm saying? But I prefer swing trading because now it kind of gives me that freedom to not be stuck in a box. For example, if you are a low time frame trader, at 3 o'clock, you need to be on the charts. At 3 o'clock, I think it's New York Open or whatever. 3:30.
Yeah, 3:30. You need to be on the charts. With swing trading, I only need to see the market like once or twice a day. Twice is just when I'm, okay, let me just see what's happening, right? And also, focusing on the lower time frames, you need to focus on sessions, like London, New York, Asian, whatever. With swing trading, there's none of that. You get what I'm saying? So, the mindset needed behind using the 4 hour, you need to have extreme patience. Like I said, there's literally 6 candles happening in a day.
Literally.
Are you going to be able to see 6 candles play out in a day? You get what I'm saying? So it's one of those things where you need to practice that patience. No one was born with patience. You just have to practice it. You know what I'm saying? Also, I'm also working on my patience, though I think it's where I want it to be right now because I'm at a point where I could just sit for days without taking a setup and still feel okay.
Yeah.
You get what I'm saying? But then back then when I was still transitioning, it was hell. You get what I'm saying? So yeah, you need to have extreme patience. And also you need to be doing other things except for trading. You know what I'm saying? So like I encourage people who watch my YouTube, with the strategy, you don't need to leave your job. You don't need to leave school. Because believe it or not, I'm getting DMs from people asking me if they should leave school. I'm talking about high school.
Oh,
I'm high school. I keep on telling them that's never the case.
Yeah.
That is never the case.
Yeah.
You shouldn't leave school for trading.
Yeah,
You know what I'm saying? But yeah, this strategy is catered for anyone who wants to have like freedom, or anyone who has a 9 to 5, or anyone who's still in school studying. Only need to look at the charts once or twice a day, in the morning or in the evening. You decide.
And it's not particularly at a particular time.
Exactly.
To be honest, because obviously, if you have your buy limits over there,
you're done.
You're
done.
literally done. Because your stop loss is there, your take profit is there.
You're gonna be tapped in when price reaches that level.
Close the MT for your whatever trading software you
MT5. Then just go on about your day.
Go to your shift, do your job, and then
do it properly. Don't keep. You're not gonna be looking at your phone the whole time, looking at the 5 minute and stuff. So yeah, this is very good for people who are in school and also maybe have a 9 to 5, or if you just hate chat time. Because I personally hate chat time. As much as that might sound ironic, I hate being on my chats. You get what I'm saying? So yeah, this is a perfect fit for me. I believe everyone out there has a fit for them. This is a fit for me. You get what I'm saying? So yeah, you need to have extreme patience to be able to transition from scalping, day trading to swing trading. Yeah, so psychology needed is something else, I have to say. Something else.
I can imagine. And I like that you really did mention that, because I think I always have a lot of people asking me, should I leave their job for trading? And I discourage that heavily. So I think I've seen, but I think also we can people, if you really want it, you balance the two. You know, I know you decided to take a different journey from a lot of people, and I know you've learned a lot about yourself. You know, if you guys haven't watched the episode I did with Ballo, we'll leave the link down, and then please go check it out on the channel. It's really great. I think it's a great build up. This is a great build up towards that. So no, but Ballo, thank you very much for coming. I know when I call on you, you never disappoint. Thank you for this. This was very straightforward, to the point. I think there was
very simplistic.
Obviously, if it's going down, obviously we just flip the whole vice versa, and then we just do the whole thing. And thank you for explaining the daily, why you trade the 4-hour time frame. So you never look at the 1 hour.
Nah, I don't have it on my, as part of like the time frame that I've selected. I don't have it. It starts from the 4 hour and the daily. That's only 2 time frames.
That's it.
What's
your wait time for your average wait time? I know it differs from trade to trade, and also how do you pick your lot size? Because I think, you know why I'm asking that, because I'd like to believe every setup is slightly different from the rest. Because even if we can draw this to there and say 0.71, but you might find that this is bigger than the previous one. So how do you...
Still going to remain the same. My RR is still going to remain the same.
In your lot size...
My lot size
does it change? Does it depend on the...
It changes. There was not a single time where I've used the same lot size. It changes. Like the lot size depends on the stop loss size. Obviously, over here, this is an average looking range from the low to the high. Let's say this is maybe 35 pips. Right. I'm talking about the stop loss size. Like this is the stop loss size, by the way. This might be 35 pips. Then you get a setup where we have now a bigger range. Right. Now drawing the Fibonacci from the low to the high, you'd find that this is bigger. Right? 0.71. This is bigger. You might find now the stop loss size changes to now it's 66 pips, for example. Right. My lot size depends on the lot size as well as how much I want to risk. Basically, so hence I'm saying there's not been a single time where I've used like the same lot sizes, because my stop loss sizes in pips changes like all the time. And
I think that's very important to kind of just put out there, because I think a lot of people come into this thing, it's like, yo, I only use 0.50 the whole time.
I get comments of people asking me what lot size I use. I feel like that's the most irrelevant or useless question you could ever ask. What lot size do you use? There was not, like I said, there was not a single time where I've used the same lot size. always changes.
According
Never
to the
same.
setup.
Yeah, always
Okay.
changes. Always changes. I remember that also per setup, the stop loss size, the stop loss size in pips changes. So obviously my lot size is also going to change.
But I think this must not go over people's head. Regardless of this and this, it all comes down to
The risk.
1%.
Yeah.
This is 1%, this is 1%.
Now if I want to risk 2%, the lot size changes. Yeah.
Okay, so, but I'm just saying, if we were to take these two trades and we say the risk is the same, you still want to risk the same, but obviously this will be determined by your lot size.
Exactly.
Okay.
Exactly.
Nice.
Exactly.
This is just based, I'm only drawing this based off of your 2.45.
Yeah. So even this, as you can see, 35 pips.
Yeah.
66 pips. Even though I want to risk 1% on both, it will still look different. The lot size will still look different.
Yeah.
Yeah.
No. Perfect. No. Thank you very much, Ballo, for this. This was great. This was really great. Thank you for explaining some. I have a better understanding of certain things right now.
Now you see, when you look at my chart, you see what's going through my head.
Yeah. No, thank you very much, and wishing you all the best moving forward.
Thank you, man.
All right.
I appreciate it.
All right. Thank you guys so much for watching Chartmasters with myself, Mbani. I will see you guys on the next episode, and a big shout out to our sponsor, Exness, for making this possible. I'll see you guys next week, and we're out.